Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to session 14 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for our 14th session on various investment options offered by mutual funds. Alright, so now let's get started with our learning session today and let us see the various categories of mutual fund schemes available and the investment options they offer for investing your hard-earned money. The world of financial innovation and exuberance has introduced many of us to numerous exotic financial products. Mutual funds too, over the years, have become innovative in their offering, and today investors have so many options they seem often either confused or completely swayed by the exuberance. You see, while numerous categories for investing may be good, you need to recognize what each of them aim for and whether they suit your risk profile and investment objective. And this session of our learning initiative does exactly that by educating you on various categories of mutual fund schemes and the available investment options. So let's first take a quick view at the typical classification of mutual fund schemes and then understand each of them in detail. The table here exhibits classification of a mutual fund scheme on the basis of tenor, asset class, investment philosophy, and geographic regions. You see, this broader classification makes way for various categories of mutual funds that we shall learn now in detail. First, mutual fund schemes by tenor. As you may know, tenor refers to the time. Mutual funds can be classified on the basis of time as under. First, open-ended funds. These funds are available for fresh subscription and redemption all throughout the year. So, investors have the flexibility to buy and sell any part of their investment at any time at the prevailing price, that is the NAV. These funds do not have a fixed tenor, so their existence is perpetual until they are wound up or merged with any other mutual fund scheme. The unit capital of an open-ended mutual fund scheme keeps varying, but it should be noted that an open-ended mutual fund scheme is not obliged to keep on selling new units at all times. If the management thinks that it cannot manage a large size fund optimally, it can stop accepting fresh subscription requests from investors. However, an open-ended mutual fund scheme can repurchase the units at all times. Such funds are susceptible to worry of regular and sudden redemptions. Then comes close-ended funds. They are available for subscription during a specified period, so they are unlike the open-ended ones. Buying into a close-ended mutual fund scheme after its NFO period is not possible. This is because they have a time period until which investors' money is locked in. This means new investors cannot enter, nor can existing investors exit through a repurchase till the term of the scheme ends or an exit window is offered. However, to provide a platform for existing investors to exit, close-ended mutual fund schemes are listed on the stock exchanges. Through this way, investors can buy and sell units on the exchange through a broker just as you do with stocks. The unit capital first issued does not change as a result of trading on the stock exchange. It remains constant. However, the units of a close-ended mutual fund scheme may trade at the premium or at a discount to the NAV, depending upon investors' expectations of the scheme's future performance and prospects. Due to the lock-in period, close-ended funds are not prone to regular and sudden redemptions. Then comes mutual fund schemes by asset classes. In one of our earlier learning sessions, we introduced you to asset classes such as equity, debt, gold, and real estate. Mutual funds provide you with an opportunity to invest in such asset classes by investing in funds from their stable. So let's learn about such funds. First, equity funds. As the name suggests, these funds invest in equity as an asset class in shares, stocks, rights, warrants, and other equity-related instruments. They may, as per their investment mandate, invest in the respective market capitalization segments such as large cap, mid cap, or small cap, or even hold a mandate to invest across market capitalization and adopt a flexible investment approach. They may invest in growth stocks, value style, or dividend yielding stocks depending on the investment objective, and this in turn sets the nature of the schemes. Thus, on the basis of the nature of the stocks it holds in the portfolio, equity funds may follow a growth style, value style, or a combination of both called as the blend style of investing, which we will learn in brief as we progress with our learning session today. As far as the suitability is concerned, equity funds are suitable for investors with an appetite and tolerance for high risk and want to earn better real rate of return, that is the inflation adjusted returns, in the long run, who invest with an objective for meeting their long-term financial goals. Debt funds or income funds. These funds invest in debt and instruments such as certificate of deposits, corporate bonds, debentures, fixed deposits of banks, commercial papers, treasury bills, interbank term money, and money market instruments, amongst others. Debt funds are divided into two subcategories, that is short-term and long-term, on the basis of the maturity profile of the papers they hold. And then there are some which may invest dynamically across maturities. Debt funds are of various types as depicted by the chart here. So let's see the various types of debt funds. Debt funds are broadly classified into three types: ultra short-term debt funds, short-term debt funds, and long-term debt funds. Ultra short-term debt funds are further classified into two types: money market funds and liquid funds. Short-term debt funds are classified into three types: short-term gilt funds, short-term income or short-term floating rate funds, fixed maturity plans, and long-term debt funds are classified into two types: long-term gilt funds and long-term income or floating rate funds. So let's learn about these in detail. Liquid funds mainly invest in very short-term money market instruments with maturity of up to 91 days and also invest in call money. Ultra short-term debt funds, the portfolio of these funds comprises of a mix of certificate of deposits, commercial papers, call money, and other money market instruments with slightly higher maturity than the instruments held in liquid funds. Floating rate funds. They typically invest in short-term instruments offering flexible interest rates, that is, whose interest rates reflects the prevailing interest rate in the country. Short-term income funds. They have an exposure to short-term bonds, deposits, and NCDs. May also invest in T-bills and government securities with a maturity of less than 3 years. FMPs invest in bonds, NCDs, and money market instruments that have a maturity profile in line with the horizon of the scheme, that is the fixed maturity plan. Then dynamic bond funds invest in short-term as well as long-term bonds and NCDs. They may also invest in government securities with a maturity of up to 5 years. Long-term income funds invest in bonds and debentures with a maturity of more than 5 years. They can also invest in government securities with a maturity profile of 5 to 10 years. Gilt funds, or also called as GSEC funds, invest only in securities issued by the central and/or the state government. As far as the suitability is concerned, debt funds are suitable for investors who are rather risk-averse and do not mind compromising on real rate of returns they would earn in the long run, and generally have a near or a short-term financial goals. But while doing that, care should be taken to select from various categories of debt mutual fund schemes. Then the next is hybrid funds. As the name suggests, these funds invest in multiple asset classes which would hold equity instruments, debt instruments, and even gold. They are mandated to allocate a certain portion of their AUM in the respective asset classes. Depending upon the dominant exposure to equity or debt, they are classified as equity-oriented hybrid funds and debt-oriented hybrid funds. Balance fund is an example of equity-oriented hybrid fund, while MIPs or monthly income plans and capital protection funds are examples of debt-oriented hybrid funds. As far as the suitability is concerned, hybrid funds can be suitable for investors who want to tactically allocate the assets, but the selection therein should be done as per the risk appetite and tolerance in order to hold an appropriate fund in the portfolio. Then there are real asset funds. These funds invest in physical assets such as gold and real estate. Gold exchange traded funds and real estate investment trusts, also known as REITs, fall within the category of real asset funds. As far as the suitability of real asset funds is concerned, those who wish to invest in other asset classes and diversify the portfolio by assuming high risk thereto can invest in real asset funds. Then mutual fund schemes are categorized by the investment philosophy as well, wherein the first one is diversified equity funds. These funds are primarily equity funds investing across sectors and market capitalizations. They invest in equity and equity-related instruments following the basic tenet of investing, that is diversification. But care should be taken to select them wisely. You see, within the diversified equity funds, there is an array of schemes on the basis of the style of investing and market capitalization they follow. So let's learn about it. First, value style. Value investing refers to buying stocks whose market value is severely deviated from their fair intrinsic value. Unlike market value, which is readily quoted, the intrinsic value is not available easily and has to be estimated by conducting thorough fundamental analysis by studying various ratios such as price to book value, price to earnings, dividend yield, price to sales, amongst a host of others. Value investing also revolves around a set of investment principles which are: companies should have sound management, earning capacity of the companies which can be judged by brand equity, earnings per share, growth rate, amongst a host of others. Then consistency in returns, prudent approach to debt financing which can be judged by paying attention to capital gearing ratio, debt service coverage ratio, interest service ratio, financial leverage, amongst a host of others. Buying at the right price is also what value investing is all about, which can provide you enough margin of safety. Then, of course, long-term investment approach is also a basic tenet of value investing. As far as the suitability is concerned, value style funds are suitable for those who give due weightage to tenets of value investing that we just learnt of. Then comes growth style. Growth style of investing focuses on the following factors for stock picking. Companies that deliver above average earnings and have with them strong competitive position and opportunities galore for further growth, thus enabling them to pursue the growth path. Companies that have high PE ratio or a PE multiple, but at the same time make them appear inexpensive when looked at the future growth potential it has to offer. Companies with low dividend yields, through which instead of declaring dividend from the earning, the company uses accruals for facilitating growth for the company. But following the aforesaid distinctive principles, growth investing also follows some of the value investing principles while selecting companies. Hence, even the legendary value investor Mr. Warren Buffett too stated that there is no theoretical difference between value investing and growth investing. He said, growth and value investing are joined at the hip. And hence, recognizing that, later Mr. Peter Lynch pioneered the concept of GARP or GARP, growth at reasonable prices investing, wherein he mentions that one should look at consistent earnings growth that are above the market level, but at the same time avoid companies with high valuation while following growth investing. Growth style funds are suitable for those who are willing to assume high risk in their endeavor to create wealth at an accelerated pace. Then comes blend style. As mentioned earlier, blend style of investing follows a combination of value and growth style of investing while picking stocks for the portfolio. Hence, it depicts the traits of both, but to what extent the fund manager follows each of them remains his prerogative. As far as the suitability is concerned, blend style funds are suitable for those who wish to follow the tenets of value investing, but at the same time would like to assume a little more risk and accelerate the pace of wealth creation. Now, apart from the typical or the more commonly known styles of investing that we just learnt of, a mutual fund scheme could also have the mandate to follow the opportunity style. Opportunity style funds, as the name suggests, invest in stocks of companies across market capitalization segments, that is large cap, mid cap and small cap, and across sectors. They hold a flexible investment mandate due to which these funds stand a better chance to benefit from attractive investment opportunities in various market segments. However, in practice, this depends mainly on the fund manager's expertise in identifying and tapping promising investment opportunities well before others. Opportunities funds are suitable for those who wish to take advantage of opportunities across sectors and market capitalization optimally, but by assuming a little high risk as against a typical diversified equity fund. Now, apart from following a particular style of investing, equity mutual funds can also offer schemes that are mandated to invest a predominant portion of their assets towards respective market capitalization segments. So let's learn about such funds. First, large cap mutual fund schemes. These funds are usually mandated to invest a predominant portion of their assets in large cap companies which stand at the uppermost layer of the market capitalization pyramid. Some traits about large cap are companies with well-established businesses and stable revenues. They have high market share, usually are well researched. Their performance is more predictable than highly volatile mid-caps. They have the ability to weather the unfavorable economic conditions better. Hence, these companies generally command a premium over the mid and small cap companies. Large cap funds are an indispensable part of the equity portfolio, irrespective of the risk appetite of the equity investor. So even if you are having a large appetite for risk, you must include in your portfolio some petite portion of large cap funds along with mid and small cap funds showing a dominant portion. Mid cap mutual fund schemes. These funds are usually mandated to invest a predominant portion into mid cap companies which fall below the large caps but above the smaller cap companies in the market capitalization pyramid. Some traits about mid cap companies are they are well established but have potential to grow as they are yet in the growth stage of their life cycle. They are leaner in size as compared to the large caps but have the ability to accelerate returns on investments. They are often less researched and hence more often available at a discount to the large caps. They are more volatile and not as stable as the large caps as they tend to show fluctuations in profits and at times struggle to sustain when the going gets tough. And for this reason, investment in mid caps is considered risky, but it could be well rewarding over the long term. As far as the suitability is concerned, mid-cap funds are suitable for those who are willing to assume high risk in the endeavor to clock alluring returns. This is because while mid-caps show a tendency to do well during the upside of the market, they also tend to plunge rather violently during the downside of the equity markets. Hence, although one could invest as permitted by risk appetite, it is imperative to stay invested for the long term to strike a better risk-return trade-off. Then there are small cap mutual fund schemes. These funds, also known as micro-cap funds, are usually mandated to invest a predominant portion into small cap companies which fall below the market capitalization of mid-cap companies. So, they are at the bottom of the market capitalization pyramid. Some traits about small caps are these companies are often underowned as very few investors have the heart to invest in under-researched smaller companies. They are leaner in size as compared to mid-caps. The volume of transactions on the stock exchange and liquidity in small caps is low. It is noteworthy that low volume creates price impact when sudden buying and selling shock occur. Thus, investing in small cap carries very high risk, but they have the potential to generate supernormal returns. Thus, as far as the suitability is concerned, small cap funds are suitable for those who are willing to assume very high risk in the endeavor to clock supernormal returns. Small caps, as learnt, often have fewer transactions on the exchange and low liquidity, and thus instills volatility in them when sudden buying and selling occurs. Hence, although one could invest as permitted by risk appetite, it is imperative to stay invested for the long term to strike a better risk-return trade-off. Then there are multi-cap mutual fund schemes. These funds are facilitated by the investment mandate to invest across market capitalization, that is large caps, mid caps and small caps. Thus, by doing so, they spread the risk across market capitalization and even capture investment opportunities across segments, depending upon the market scenario they're in. Moreover, they are not confined to a particular style of investing, which allows them to follow a value, growth, or a blend style of investing. Multi-cap funds are suitable or appropriate if you're willing and or want to take exposure across market capitalization to tap opportunities and at the same time want to diversify the risk. Then comes flexi-cap mutual fund schemes. These funds, as enabled by their mandate, aim to optimize exposure to every market capitalization segment depending on its attractiveness. In other words, a flexi-cap can work as a large cap fund if the fund manager expects a better performance from large caps, and it may serve as a mid and small cap if the fund manager turns bullish on mid-sized companies. Moreover, some funds go one step ahead and switch between asset classes such as debt and equity with the flexibility to go 100% on either sides. As far as suitability is concerned, flexi-cap funds work as all-weather funds for portfolio and are appropriate for those who wish to optimally capitalize on available opportunities within market capitalization and even asset classes wide a flexible investment mandate. Then comes sector or thematic funds. These funds focus on investing in a particular sector. Thus, a dominant portion of the fund's assets is invested in respective sectors, which could be FMCG, power, IT, media and entertainment, banking and financial services, etc. Thematic funds are a variation to sector funds and have a slightly broader mandate for investing by following a theme. Thematic funds could invest in themes such as infrastructure, consumption, etc., which invest in stocks that comprise a theme. As far as the suitability is concerned, investors who are willing to take very high risk and are adequately diversified but yet wish to follow their conviction on investing in sectors or themes may consider such funds. Then there are index funds as well. These funds are aligned to the respective benchmark indices. The portfolio of such funds replicates the composition in terms of allocation or weightage of the chosen index. These funds nearly mirror the performance of the designated benchmark index. Thus, index funds are passively managed as against diversified equity funds, sector funds, and hybrid equity funds, which are actively managed. They carry with them low expense ratio, relatively low portfolio turnover ratio, and thus a low risk as compared to actively managed mutual funds. As far as suitability is concerned, index funds can be considered by those who are naive to mutual fund investing, as they generally command low risk amongst equity funds. So if you are relatively risk averse but yet want to take exposure to equities and mirror the performance of the benchmark index, then you may invest in such funds. Then comes exchange traded funds, ETFs. These funds are traded on the exchange and therefore called exchange traded funds or ETFs. They can be bought or sold on the stock exchange on a real-time basis through your registered stockbroker. The AMC may not offer sale and repurchase of units, as in the case of an open-ended funds where the NAV is declared. ETFs are traded on the respective stock exchanges and are benchmarked to the respective indices. Today, ETFs are available for pre-specified equity indices and also those which mirror the price of gold. Most ETFs are passively managed. ETFs are suitable again for naive investors looking for lower cost, convenience of investing, and who are relatively risk averse but yet want to take exposure to equities and mirror the performance of the benchmark index. Then there are fund of funds, FOFs. FOFs invest their money in other funds of the same mutual fund house or other mutual fund houses. So it's unlike the other mutual fund scheme which invest in stocks and debt instruments directly for portfolio construction. FOFs could have a mandate to invest in funds focusing on investing in various asset classes and markets or regions. Thus, FOFs provide an opportunity to create a diversified portfolio of various mutual fund schemes whereby one can avail of the benefit of diversification by the fund manager and investment style, followed by the funds in the portfolio. FOFs may help in diversification across types and investment style by investing in a single fund. It relieves you from the process of selecting the right mutual fund schemes, since FOF fund manager takes care of that. It reduces hassles such as multiplicity of transactions, filling forms, maintaining multiple account statements, and tracking multiple mutual fund schemes, usually experienced while investing directly in regular mutual fund schemes. But FOFs may have a high expense ratio as compared to regular mutual fund scheme. Thus, as far as the suitability is concerned, FOFs are suitable for small and new investors willing to build a portfolio of mutual funds but lack resources and skills to research and select the right mutual funds. Also, for those who want to eliminate the hassles of maintaining and tracking their investment in multiple schemes but are ready to bear a high expense ratio. Then comes fixed maturity plans, or FMPs. FMPs are close-ended schemes with a fixed tenure that cease to exist thereafter. Being close-ended, FMPs are listed on the stock exchange. They invest in debt and money market instruments of similar maturity as the stated maturity of the plan, which means a 90-day FMP will invest in debt and money market instruments that mature with 90 days, like 3-month series or certificate of deposits, 3-month CPs or commercial papers, etc. Unlike FDs, the maturity amount in case of FMPs is not fixed. There is no default guarantee or insurance as in the case of bank FDs that comes with a DICGC guarantee or an insurance up to a sum of Rs 1 lakh per bank. Also, unlike bank FDs where investors have an option to prematurely exit, FMPs do not provide investors with an option to exit. However, exiting prematurely is permissible through a sell transaction on the stock exchange. As far as the suitability is concerned, FMPs are suitable to those who wish to clock better post-tax returns as compared to bank or corporate FDs, but who are willing to take slightly high risk since the maturity proceeds are not guaranteed. Then there are mutual fund schemes which are classified by geographic regions. First, country or region specific funds. These funds invest in securities, equity and/or debt of a specific country or region or economic groupings, that is, developing and emerging economies and developed economies. The underlying belief is that chosen country or region is expected to deliver superior performance, which in turn be favorable for the securities of that country. Such funds have an exposure to currency risk, interest rate risk, macroeconomic risk, regulatory risk, and geopolitical risk, but they can facilitate geographical diversification. Thus, as far as the suitability is concerned, country or region specific funds can be suitable if one is adequately diversified within the domestic portfolio and is looking for further diversification across countries or regions but is willing to bear high risk emanating from such an investment. Moreover, care should be taken while selecting such funds. Then comes offshore funds. Offshore funds are domiciled outside the home country where the mutual fund house is registered. These are usually established in countries which provide significant tax advantage for foreign investors. Some popular countries for offshore investments are Isle of Man, the Bahamas, Bermuda, and the Cayman Islands. Thus, they ought to comply with the regulation of the country where they are registered. Offshore funds mobilize money from investors for the purpose of investment outside their home country. Offshore funds invest in listed equities and debt securities. They facilitate geographical diversification. Nonetheless, investors in offshore funds are exposed to regulatory risk, geopolitical risk, macroeconomic risk, and currency risk. Thus, as far as the suitability is concerned, before investing in offshore funds, one should have a fair diversification within the domestic portfolio and then, if the risk appetite permits, may invest in offshore funds for geographical diversification. But utmost care should be taken while selecting offshore funds, and one should avoid those which have a mandate to take an acute country-specific exposure. Now, having learned the classification and the various types of mutual fund schemes therein, Let's learn about the various options that mutual fund houses provide investors with, such as dividend, growth, and bonus. First one, dividend option. This option facilitates investors to book profits in the form of dividend and provides further sub-options such as dividend payout and dividend reinvestment. Dividend payout option. This option proposes to timely pay distributable surplus or profits to investors in the form of dividends, either through checks or ECS credits, thereby facilitating them to book profits. This option can be selected by those who are in need of cash flows during investment horizon and may not have regular flow of income. Dividend reinvestment. Under this option, instead of providing dividend checks or providing ECS credits, the dividend amount declared by a mutual fund scheme goes into buying additional units of the same scheme where one is invested. So it keeps reinvesting the dividend proceeds in the same scheme. This option is suitable for investors who are not in need of cash flows in the form of dividend during the investment horizon, but instead would prefer to add additional units to the same scheme where they are invested via the dividend declared for the scheme. It should be noted that selecting the dividend option in no way makes it mandatory for the mutual fund house to declare dividends. It is solely subject to the performance of the respective mutual fund scheme, availability of the distributable surplus, and discretion of the trustees. Then comes the growth option. This option facilitates compounded growth in value of your mutual fund scheme subject to the investment bets taken by the fund manager. This option is suitable for those who are not in need of cash flows in the form of dividend during the investment horizon, but would instead prefer to invest their hard-earned money for compounding their wealth. Then there are some mutual fund houses and their schemes which also offer the bonus option. Under the bonus option, investors are not paid regular dividends. Instead, they continue to receive bonus units in accordance with the ratio declared by the fund house. Very few mutual fund houses have this option. As far as the suitability is concerned, this option is suitable to those who wish to add units to their investments as per the ratio of bonus declared by the mutual fund house for the scheme. Overall, while selecting between options that we discussed, one should align them well in accordance to what the financial plan calls for, so as to achieve the life goals being addressed by the financial plan. Today, while investing in mutual fund schemes, investors can opt for either the direct plan or the standard plan. So let's learn what they mean. First, direct plan. Opting for this plan facilitates investors to invest directly in mutual fund schemes offered by the fund house. So here, investors can bypass the distributor's channel. Direct plan has a lower expense ratio as against the standard plan. So the investors can save a good deal of money and thus may fetch better returns. As far as the suitability is concerned, savvy investors who use online platform and don't mind investing in mutual funds using e-route may be better off opting for direct plans. Likewise, those who take independent advice on mutual funds from a mutual fund research company can also consider investing through direct plans. Then comes standard or regular plan. By opting for this plan, investors go through the distribution channel, whereby investments are done through mutual fund distributors, agents, relationship manager, or an advisor. Servicing issues are taken care of by the mutual fund distributor, agent, relationship manager, or an advisor. Standard plan commands a high expense ratio. Thus, eventually returns fetched under a standard plan could be a little lower as compared to a direct plan. As far as suitability is concerned, investors who opt for a standard plan can be those who are looking for convenience, getting service, not having access to mutual fund research, and therefore do not mind paying high expense ratio and compromising a little on the returns generated. So before we end our session today, here are some key takeaway points. Care should be taken while selecting a mutual fund scheme, so as to have the appropriate ones that can meet your financial goals. Have funds from respective categories of mutual fund schemes as per your investment objectives. Equity funds carry high risk and therefore are suitable if you have an appetite and tolerance for high risk and want to earn better real rate of return. Equity funds are suitable if you are having a long-term investment horizon and wish to clock better real returns. Debt funds are suitable if you are risk averse and do not mind compromising on real rate of returns. Tactical allocation can be facilitated by hybrid funds. Sector or thematic funds carry very high risk, while diversified equity funds expose you to lower risk by following the basic tenet of investing, that is, diversification. FOFs provide an opportunity to create a diversified portfolio of various mutual fund schemes by investing in a single fund. Country or region-specific funds and offshore funds facilitate geographical diversification but expose you to regulatory risk, geopolitical risk, macroeconomic risk, and currency risk. Selection between dividend growth and bonus options should be done carefully in alignment to your financial plan. Opting for direct plan helps to clock better returns as compared to standard plan due to relatively low expense ratio charged by them. So to end our learning exercise today, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.